The San Francisco Bay Area is topping the charts for home price declines, and the worst of it may not be over. In today's video, we're going to look at where the median price is for the 9-county Bay Area in California, how much further it could fall, and when we might see a bottom. Let's get into it. Today's video is an update to my last video on the Bay Area housing market I released back in October. Back then, the median home price for the 9-county Bay Area was down by 10.5%, and based on what was happening with affordability issues driven by a surge in mortgage rates, I found that prices could fall by as much as 32% in order for the market to get back into balance. In the most current data from the California Association of Realtors, which I have seasonally adjusted, the median price for the Bay Area was $1.18 million as of December 2022, which was 16.3% lower than the peak in April 2022. In my last video, I based my 32% market crash scenario on assumptions for what would happen with affordability. When I calculate the average housing payment as a percent of median household income, I find that it is currently at 66% as of December. For the market to get back into balance, this percentage would need to return to 50%, which has been the historical average. I'm approaching this from an affordability standpoint because it is the surge in mortgage rates that has been the driver of the price declines. In order for the average housing payment as a percent of household income to return to 50%, home prices would need to fall by 32% given current income and mortgage rate trends. Right now, we're already looking at a 16% decline in price, so it's well on the way there. The next question is, when might we see a bottom? To answer that, let's take a look at how fast prices have come down so far, and also the pace of declines we saw in the last housing crash. So, from April 2022 to December 2022, the median price has declined by an average about $28,700 per month. Looking back to the last housing cycle, the Bay Area median price peaked in April of 2007 and hit bottom in March of 2009. Over this period, home prices declined by an average of about $18,500 per month. So we can see that in our current housing cycle, prices are declining much faster. And this makes sense given how fast mortgage rates went up and acted as a sudden shock to the market. Going forward, I think we're likely to see that rate of price decline slowing down a bit as the Federal Reserve is widely viewed as nearing the end of their interest rate hikes. So for the sake of our calculation, I'm going to use the average of the rate of decline for this housing cycle and the last one, which works out to $23,600 per month. At that rate, we would reach a 32% decline from the recent peak by September 2023. So that's where we're looking at right now. The Bay Area could see a 32% decline in prices by September of this year. Keep in mind, this is not a forecast. It's a scenario based on a certain set of assumptions, primarily that affordability in the market will return to the historical average and that the rate of price declines will range between what we saw in the last housing cycle as well as the current housing cycle. I'll provide another update before it gets there, so if you want to see that, make sure you're subscribed and hit that notification bell down below so you know right away when that and my other videos come out. On this channel, I focus on forward-looking real estate analysis, and I cover the national level indicators as well as the major regional markets like the Bay Area. If you want a more in-depth look at how I got to some of my numbers in my last video, make sure to check it out for more details. I'll put a link to it in the description down below. And if you found this video helpful, don't forget to leave a thumbs up to support the channel and help it grow. Thanks for stopping by, and I'll see you in the next video.